Welcome to News You Can Use, presented by Supreme Lending. News You Can Use offers timely information related to the housing and housing finance industry that we believe will benefit you and your customers. This is News You Can Use.
What's the definition of a black swan? Because that has kind of been attached to the coronavirus. Could that be a black swan in terms of the economic happenings?
So, could the coronavirus be a black swan? It could, although there has been discussion from the Center for Disease Control over the last couple of decades about the rising potential for some sort of a global problem because the resistance has been developed to penicillins and some other of our traditional treatments. So it's not completely unexpected or out of the blue, but it is definitely something that we're watching that could change things if it does not come under control.
So when our viewers hear the term black swan, it's really just an event that you cannot foretell, that just shows up, that could have disruption in terms of what's happening in the economy, that cannot be forecasted. I'll remind you to remind the board at Fannie Mae that there are black swans that don't get contemplated when you go into your forecasting models.
Right.
I'm still amazed
at
that.
Right.
Yeah, I'm still amazed at your accuracy for last year. Doug, let's get started first with looking backwards. 2019, you and the team at Fannie Mae forecasted a 1% increase in annual sales in 2019. How did 2019 actually turn out?
Well, from a percentage basis, it was up 1.1%. So, I'll take that error rate. I'd like to be able to achieve that every year. In terms of the number of sales, the forecast we made in January was for 618,000. It actually turned out to be 681,000. So about 60,000 more new homes sold than what we had forecast. And then existing homes, we had forecast 5,375,000, and the actual was 5,340,000. So about 35,000 less than we had forecast. So on balance, up 1.1. So our total forecast was pretty close.
Yeah, I would say, Doug, listen, when we're talking about the numbers that we're talking about, that ought to enable you to keep your employment at least one more year. Most people that are in the audience today, when it gets down to forecasting, to come in 0.1% within the target, I'd say that's pretty darn good. So. Wow. Just over 2 months ago was the last time we talked, Doug, and that was BC, right? Before Corona. Yeah. Exactly. And wow. So the good news is that you're healthy, and I'm glad your family's doing well, and I am as well. And thank you for asking about that earlier. And we're looking forward to having you now with an additional challenge. If you thought your job was difficult forecasting in the past, we now understand that it's going to be a bit more difficult for you. But welcome back to News You Can Use, my friend.
Thanks. Great to rejoin you.
Yeah. So today we have a number of leaders. They're running real estate businesses throughout our footprint, and they're our partners. And we hope today we can just give them a little bit further insight with regard to, and we all understand that this is a very fluid and dynamic event. So, but we thought as a partner that giving them the very best insights about how they can direct their business from this point forward obviously is critical. So I've got a couple questions for you. Let's start out with this whole concept of forecasting, which when you're talking about housing units, millions of different variables and millions of different units. And last year, of course, again, your forecast was remarkable. As you, BC, before Corona, as you and the team forecast on behalf of Fannie Mae, what are the critical data inputs that you use, look at, consider, that help give you insights with regard to what's going to happen in housing in the coming year?
Sure. Just in terms of structures, we use three things. We use models, and I'll talk about that in just a second. And then we use judgment, And we use anecdotes to some degree to see whether the stories that we hear from people that are on the street line up with what the models in our judgment suggest are appropriate. A model is just an averaging through past data to project what might happen in the future. And if an event occurs which has never happened before, then the models will by definition be wrong. So even judgment becomes an even bigger part of the forecast process than it is under normal circumstances. And of course, today, the judgments have to be about variables that we as economists don't really know. It's about disease, so it's not our expertise. So we have to look at the impact of the disease on behaviors. And the question is the incidence, the severity, and the duration of the disease. Those three things are really the drivers today. And then in reaction to that, how do people react and how do policymakers react? So we can see in the data on a lagging basis how people react, and we can see how policymakers react. But we're not epidemiologists, so we don't, that part we take Center for Disease Control and people like that. So what are the variables that matter to housing? Well, it matters, jobs matter. We've seen 26 million claims filed for unemployment insurance in the last 5 weeks. Friday, we'll get the employment report for the month to see how much of that shows up in the unemployment rate. The one most important thing, if you're going to buy a house, you want to have a job and a stable income. So that's key. The second thing is what happens to household formation, and then how do those households migrate? This instance is very different from the 2007 to 2009 crisis in that renters are going to be much more impacted this time than they were then, because the job loss is so large in areas of employment that are more heavily concentrated in the rental space. So I think that's one of the things we'll be watching is what's the impact of the additional unemployment benefits, the lengthening of time, the increased size of the benefit. How will that impact the ability of people to meet their rents? So this is not just a homeownership issue this time, but also a renter's space. So those are some of the things that we're trying to track.
So when this whole thing, fair to say, started unfolding to be kind of the story that it is now, I just imagine that you were, it's like the scene in Apollo 13 when they had all of those things and they had to build something. They said, we have to build this out of that. And failure's not an option. So I would have loved to have been a fly on the wall at the first meeting that you ran in terms of forecasting post Corona. It's amazing.
Yeah, as you can see, one of the things we did understand, I think appropriately, was that there will be significant regional differences in how this impacts the economy. So we concluded that based on some work that we had done in stress testing in the company a couple of years ago, which we said one of the potential recessions that would come would be a regional recession. So for example, the discussions on trade, that might impact some markets quite differently than others. And of course, that's where the global interconnectedness from trade has actually brought some of the coronavirus into some markets differentially. Not just trade, but travel. So that international connection, we did have the right instincts about the regional differences, but it's make it up as you go, in part, trying to find, in this case, those anecdotes which are meaningful. And I'll give you one other set of anecdotes that's very meaningful. It's going to be meaningful about how we come out of this. I've talked to 2 small business people, and 2 of my staffers talked to 2 restaurateurs. The 2 small business people said to me, I've been approved for the money, for the federal benefit, but I don't know the rules, So I'm not using the money yet because I don't want to take an action that they're going to come back after the fact and say you shouldn't have done that. So that's one thing that tells you the progress that small businesses will make will be slower than you think because not all the rules are yet understood. The second anecdote is I've been telling the leadership that they should expect an extended higher level of unemployment than prior to the passage of the bill, because the federal government adding $600 a week to the unemployment benefit is going to incent some workers not to go back to work because they'll make more on unemployment than they would if they had still been working. And my staff, having talked to 2 restaurant owners, found they're opening up, but the employees won't come back because they're making more money on unemployment than they were when they were working at the job. So that's just to give you a feel for how you can fit models and judgment and anecdotes together to structure a view of what's coming.
Well, I think one of the things, because the job numbers are just, they're overwhelming, right? I would encourage all of us to take a day off on Friday so we don't watch the news on Friday, because it'll be sobering to get the kind of headline number, if you will, for unemployment, knowing that that's such a big indicator of the future of our business. But anecdotally, as I shared with you the other day, our initial demand for being curious about home loans for purchase activity has retained a really high level of strength. And it sounds to me like that's because the job losses we've had to date have been, in principle, to your point about renters, on the lower end of the economy, so that some of those folks wouldn't have been necessarily in line to become homeowners anyways. So maybe that's why we're still seeing some demand. And I assume that's factored into your forecast.
Absolutely. Our view is that salaried workers will take less of a hit from the downturn than hourly wage workers, and that seems to be bearing out. And so what you've got is an offsetting benefit if you are confident about the continuation of your employment as a salaried employee, and we're close to the buying scenario to begin with. The fact that interest rates have come down as far as they have actually supports the incentives for you to enter the purchase market. I think you probably remember a couple of years ago we talked, and one of the things I said at that time is the supply-demand imbalance suggests that in a modest recession, housing would actually be a cushion because demand growth has been stronger than supply growth. Well, this is not a mild recession. This is going to be a pretty significant recession, but the principle still holds true. And it's even augmented by the disease. So what we're seeing is the number of listings has fallen dramatically nationally because people who have a house to sell have 3 things going on in their mind. One is, will I be able to get the price that I feel I need to have if I sell? Will people be willing to walk through my house on fear of the disease, or do I want people walking through my house on the fear of the disease? And should I just wait if I don't have to sell? Should I just wait? So the listings, the supply side of the market has actually slowed more significantly than the demand side, to your point. And our home purchase sentiment index comes out on the 7th. You can watch that, and we'll talk in that about the balance of supply and demand and what people are thinking about interest rates and price.
So, we've said from the beginning, we've been telling the viewers that, the things that we're watching for really are threefold. The road to recovery, if you will, as we communicated. One is that the Fed has to do their job. And the second is that that Washington has to do its part, right? And the third thing is that coronavirus itself has to kind of sort itself out, either through vaccine or some other kind of remedy that changes the nature of how people feel about it. Give me a quick grade on the Fed at this point. How do you feel like they've done?
Well, they've fired every bullet that they have in the arsenal, plus some that they didn't have in the arsenal. In the short run, they have normalized a fair number of the market liquidity measures. So one of the things that has been very significant in the market is the spreads between treasuries and other financial assets. And in some markets, they blew out dramatically in reflecting the risk of the uncertainty of how far the downturn would come. In those places that the Fed has entered or reestablished a prior program, the spreads are coming back to something more normal, or at least pre-crisis, if you do that as the normal measure. In those places where the Fed has not either launched a program that they have suggested, because they have some programs they've said they're going to launch, which are not yet fully operational, in those places, the market measures are still distorted. So I would say they've done well in reestablishing programs that worked in the prior crisis. They're having execution problems getting things into the market, as is the fiscal side of the household, making sure that they work. Lots of innovation taking place in policy at the moment.
Yeah, it's interesting. As I lived through, like you did, the Great Recession, the Fed, it feels like the Fed today is benefiting almost from that having happened just 10 years ago, so that they have a number of plays that were in the previous Fed's playbook. But it feels like we got to market with those a lot earlier this time around, and maybe kept it from, because when you look at the stock market just as a sole, kind of viewpoint, it would feel like, based on the numbers we've seen in unemployment and all of the things that have happened, that we would be trading much lower. You feel good about the stimulus at this point?
Of course, part of it is the rollout, and there's still quite a bit of work to be done on the rollout. I view it actually as less of a stimulus than I do as a stop loss provision. So it's simply to keep small businesses in place. That it's roughly half the employment of the country comes from smaller businesses, and so it's to help them survive until people get back into the marketplace to start thinking about going to restaurants or to theaters or places where people gather. So it's in that sense, I would differentiate it from a stimulus. A stimulus suggests there's some relatively normal level of activity, but it is receded, and you're trying to get it going. This is not a relative. This is
a self-induced coma we put ourselves into.
Yes, right? Much bigger. So it's hopefully to keep households and small businesses in play until such time as something close to normal activity resumes. So they're doing the right thing. They're trying to help the small businesses survive, and they're trying to give consumers enough that they can keep going until their employment picks up again. Those two, I think, they're important.
So, I was, the day I opened your new forecast, I got to say, I was texting you, if you remember, and you were saying it's coming. And then you gave me the date, and I was a little bit nervous about opening it because, of course, just like all the folks that are on the phone, my responsibility is the lives of a lot of people, and really directing the business requires me to get the best information. I actually will tell you that when I read that the market would be down just less than 15% this year, I was relieved. It feels like, based on the forecast, and my analysis is just in what you've done, is that we're at the worst point here in this quarter for the next, let's say, year and a half, going into 2000, the second half of 20, and then into 21. Each quarter we see housing making improvements based on the number of units. Now, of course, the caveat is none of us know what we don't know at this point, and we learned that lesson a couple of us ago, right? In a great way. But so talk us through where we're at right now. Is this the way you created the forecast? This is the low point, and then we just continue to get progress over the next 6 quarters? That's how you're seeing it? That's
pretty much it. Economists, not being the most elegant speakers in the world, that we relate to the economic activity to the alphabet, which is kind of basic. Is it going to be a U-shaped recovery, a V-shaped recovery, a W-shaped recovery? Some of those a little more creative said it's going to be a Nike swoosh recovery. But it's roughly what you said. We think that the worst month to 2 months will be April and May. And so we're out of April. We're now starting to see signs of easing in different areas around the country. It certainly is the case here in Cape Coral, Florida. They've opened up some of the walkways and reduced some of the restrictions, I think, today on restaurants. And so yesterday, the number of boaters that were lined up in the street next to us was huge as they had eased some of the restrictions on that space. So May, we'll start to see the pattern of unfolding. June is the end of this quarter, so we should see some growth in activity starting up in June. So we would see the second quarter as the roughest quarter of this. Going back to the original statement, though, about the incidence, severity, and dissipation of the virus, there is a risk, which is unknown, that if things open up, there could be a recurrence, because they don't exactly know how resistance or antibodies get built up in the population at large with this distancing. So there is a risk of a second downturn some quarters out, probably like the fourth quarter when the weather turns again, because there's some sense in which the weather may be related to the transference of the disease. So as a scenario, we have run that scenario. And part of the reason you run scenarios is when you're doing a forecast, if you don't know the values of the variables you're forecasting, then you run scenarios on different values that those variables could take. And that's where the letters come from, the V, U, and W.
It feels like your forecast is kind of like you're forecasting kind of a U. Is that right? Or because it doesn't feel like it's a V for sure, because we're not going back to where we were.
Yeah.
We're certainly just climbing out of a hole over the next 6 quarters, every quarter getting better. And if you're in business today and this is the low point, and every quarter in the next 6 quarters you felt like was going to be better than the quarter you're in, there's some degree of hope and optimism. And that is a U, pretty much how you're you would describe it.
It is. It's and the length of the bottom of that U is dependent on when the easing takes place, if there is a resurgence of the disease in some way. If not, then the U will have a shallower bottom, but the longer it takes to get see the downturn in the disease, the longer that bottom will be.
Independent of the health issues, and of course those are paramount. One of the things that I was thinking in the beginning is the mindset, consumer confidence, the mindset of a consumer. If this didn't last all that long and we started to go back to work, even if we go back 25% and then 50% over time, it just seems like that would have been or will be more beneficial to keep it from getting further down into the ditch. So I've been optimistic recently that there's been some movement on the governor's fronts to get people to slowly but surely go back in, because we have to tip our foot back in the water at some point, right? We can't just stay where we've been.
I'll give you, if you indulge me for just a minute, a historic anecdote, which reflects my current view of the American people. On the Friday of the week of 9/11, most of Washington was closed. I was in my office in shorts and a T-shirt, and CNN called and said they wanted to do a live television interview on the stock market. And I said, not happening. And they begged and begged and begged because nobody was around and all this. So finally I agreed I would do that if we didn't talk about the stock market, because I don't forecast the stock market. They're like, yeah, okay. So of course the first question they asked me is, what do you think
about the stock market
going to do, right? But I knew they would. So I said, I don't actually know, but I do know this about the American people. The American people are very resilient, and it would not surprise me if there was a strong reaction in the markets that says we're going to beat this thing, and the stock market was right back where it was when the planes hit the towers. And it was like 7 points different 30 days away. It was just amazing. It was a great stroke of luck, but I still feel that way about Americans. They're champing at the bit to get moving again. And as long as it becomes clear that there's a reasonable balance between the prevention of additional problems where lives are concerned versus the economic trade-offs, then the people are going to rally to that. So I'm optimistic longer term about how.
So you go into your next forecasting meeting. When will your next forecast come out, by the way?
The 15th of May.
Okay, so you go into your next forecasting meeting coming up here soon, and the subsequent one. What are the critical data points that you and the team will be looking at that kind of tells that we as business leaders can be watching with you right now to give us indication of maybe where your forecast is going to take us next and where the market's actually going to go next?
Well, I've been following the news clearly about how small businesses are doing in receiving and deploying the funds. So there's been, the first issuance of funding was all absorbed. That doesn't mean it was deployed. The second issuance will be absorbed, watching how it's deployed. Will the businesses, the small businesses who are employing all these folks, survive? The second is, at the unemployment level, does all that benefit get distributed appropriately to people so that they're able to meet the bulk of their obligations? So we'll be watching things like delinquencies, small business failures, employment levels. When the unemployment rate bottoms and turns up, that will be a very good sign. And we'll also be watching in the housing market, to your point about being surprised at the strength on the demand side of the equation. That's a really important indicator, because housing is one of the basic issues in human life. So if the apartment owners don't see a dramatic downturn in rent payments, delinquencies, and if we see that resilient demand on the demand side of the homeownership market, those are really good signs that we will come out of this reasonably close to where our forecast is.
Like you, I was around for 9/11, and I remember the feeling that week thinking, oh my goodness, who's going to buy a house with these kind of conditions, just the general anxieties. And I remember at the time having to explain to my children who were 12 and 10 what was really going on, right? They were old enough to know, so we had to talk to them. And a lot of parents are going through that right now with coronavirus. But you're right about the resilience, because I saw it then, and I'm seeing it again now. The relative demand with all of the economic events that are going on today is kind of taking us by surprise a bit, and in a positive way. We're still obviously way off from where we would have been just 30 days earlier, because the first quarter was just very, very, very active in our business, as you're well familiar. Before we go to questions, I've got a question I always ask you. We'll have our partners ask some questions here in a minute. Is it a good time, Duncan, to buy a home or to sell a home?
I always start with the same line. As long as you have a family budget and the purchase of the house today fits the family budget, then it's a good time to buy. And but that's the basic discipline that you need, is a good financial plan and to stick to your plan.
I've always slept better at night with people like you, knowing that people like you live in this world, rational, reasonable, practical, and help give us insights about how to run our business. So whenever I asked you that question in the past, I always thought, God, he's a little bit like my brother, or, and if he were talking to his children, what would he tell his children? Because I want our folks to know and hear from you that. I thought about asking you that question. I thought, no, I'm not going to ask him that. That would be way too hard to answer today. But I'm with you, because I would give the same advice. We don't control what we don't control, but if we feel good about our budget and our lives, then we should move on. Good afternoon. The road to recovery continues. I think probably, first of all, we're all incredibly grateful to Doug Duncan for constantly making himself available to Supreme. We became friends a long time ago, and I've always greatly valued his forecasting. He's a great human being, but he's a brilliant forecaster, and nobody knows housing better. So it was great to get a chance to catch up live today after having taking the time to look through in context with news you can use, and being able to and interested in giving you the very, very best information we can possibly give you. Because what we don't want to do is build false hope. What we don't want to do is create any kind of fear. There's plenty of that to go around. What we really want to do is we want to create for all of you as friends of our organization, partners, constituents that work in our organization. We want to create the context of information that allows you to be best informed so that you can do your job the best you possibly can, which is not to control everything in life. We obviously talked with Doug back in early February, and it was kind of an omen asking the question about coronavirus, because if you think about February, the timelines, it was not really a thing or a big thing at that point, and now it's turned out to be the thing, right? One of the stories of our generation, no doubt about it. But one of the best things that I heard him say, and there were a number of nuggets of hope that he shared. One of the things that I heard him say was a story about 9/11, and having lived through that, I remember like it was yesterday, getting in the car and driving home right after the Pentagon was hit by a plane. So there were two planes, of course, in the World Trade Center, the towers, and then the Pentagon. And I thought, my goodness gracious. And I was just under 40 years old at the time. And I was thinking to myself, if they could bomb the Pentagon, what else could happen next? And I remember thinking that evening how I was going to talk to my kids. And then I remember thinking the next day, how are we going to manage our business? What's going to happen to our business? Because it was such an extraordinary event. And it feels very similar. But the nugget that Doug offered was hopeful, that the American people are an amazingly resilient people. And I believe that's because we all desperately love our way of life. We love our way of life. There's nothing else like it in the world. We are the freest nation, the coolest. We do amazing things in terms of charity. We do amazing things in business. We just have an amazing story. And I think because we treasure it so much, really, even the differences amongst us being what they are, the backgrounds, beliefs, et cetera, when it comes time to challenge our way of life, I think we get up and do our very best work. And I'm counting on Doug's point of view on that happening again. I'm counting on all of you to do your part, make sure it happens. One of the lines that we use at Supreme, particularly when we talk about personal, professional best, is it's not where you are that matters, it's where you're going that matters. And the good news is, it seems like, based on what Doug has just shared with us, that and his forecast, that we're going to a better place than the one that we're in right now, meaning that we are at the low point of this event from a housing standpoint. And circumstantially, we should see each quarter from this point forward, and each quarter, of course, is 3 months. We'll finish the second quarter of 2020 coming up here at the end of June, and we'll go into the third quarter. But those next 6 quarters, the third quarter of this year, 20, and the fourth quarter, 20, and then all 4 quarters next year, each one is projected to be materially higher than the previous quarter. And if you were in a business, if you were investing $1 in a business today, and someone told you that from the point of the investment today, it will grow over the next 6 quarters at the pace that's being forecasted for it to grow, you would be ecstatic. That's what you would be. You'd say, I'm in, I'm ready to go. So all we have to do is let go of the first quarter of this year, because things were, let's just say, cooking with gas and housing. And of course, then we had the proverbial event. We self-induced the coma in the economy, and we've shut it down. But hopefully now we'll get it open back up, and hopefully we won't have a big struggle in doing so. So let's continue the conversation real quickly. We said from the beginning what to watch, very important, was that the Federal Reserve was going to have to do its part in monetary policy. Doug did not give them a grade, but based on his role, and he talks to the Fed on a regular, I didn't expect him necessarily to put a letter or a number on it, but he clearly confirmed that they've done everything they need to do. Fiscal policy was the second thing to watch, and that stimulus, if you will, we're on round 4 now, and probably going to round 5 coming up here soon. One of the challenges, they've done so much, is will some of the things they've done, particularly around unemployment, as Doug was describing, will it discourage people from going back to work because they can actually make more not working than working? I'm sure they'll make adjustments. The Fed will, and so will the government in terms of not only the unemployment, but the PPP program, as Doug was describing, getting that money actually in the hands of people and getting small businesses to know how it works. We had to do this almost overnight, this whole thing. So, of course, there's details that still got to get resolved and worked out. I trust that they will, because there's laser focus and has been from the very beginning. Even though you hear some of the backbiting and infighting around the Republicans and Democrats, they've gotten things done. That's the bottom line. So both in monetary policy with the Fed, fiscal policy with Washington, and then finally, Corona itself. As we said, health policy was going to ultimately have to emerge. We were going to have to get the greatest doctors, scientists, biotech companies in the world. They're here to get to work to bring solutions to this thing called coronavirus. And of course, those things are now, there's news on all of them. There's treatments that are starting to become a bit of, a real treatment with real kind of ray of hope, if you will, not a ray of light, but a ray of hope. That is remdesivir is now showing some early and really meaningful signs that it could be very helpful, particularly for those who get very sick. Vaccines, they're going to get to the finish line with a number of different options, because not only is there a lot of money, forget that, there's just a lot of motivation from a lot of folks to get this thing done. I mean, the government rarely names projects, but they've got a name for the vaccine project right now. So there's kind of an all hands on deck approach. And then testing, of course, has been a question from the beginning, and that system wasn't necessarily in place to do what we needed to do today, but it's getting ramped up as well. So there's work being done by the Fed, by the federal government, and by health policy. And if you combine that with the resilience of the American people wanting to get back to its way of life, and you're seeing that on TV. I don't, portend to be supporter of the protesters or not protesters. I do think this country is going to work to get back to normal. That's what it's going to do, because it doesn't like being, let's just say, quarantined. Me and Lisa, we did a cute song the other night. Last Friday night, we did a song called Band on the Run. And we did that because it starts out stuck inside these four walls. And then it picks up and it gets to that point where it says, we got to get out of here, right? So I think that's the way most of us are feeling now. We got to get out of quarantine and get back to our way of life responsibly. That's going to be a challenge. But again, I think everyone's on the same page, doing everything they can do. And there's going to be a lot of debates about the right thing to do and how quickly we should get back and how many people should go back. And there'll be people that may never want to go back to a restaurant. Then there'll be people like me and my wife, Lisa, who can't wait to go back to a restaurant, right? So long as it's going to be safe to do so. And we hope that that's going to be sooner or later. In the meantime, again, remind all of you that what you can do is you can help your friends that are restaurateurs and otherwise by ordering takeout, by doing anything you can. Just drive by if you still got a job and drop off a nickel or a dime, a shekel or two. All right, let's move into, again, the housing forecast that Doug did put out. And again, I'll get you updated on the 15th of May of his new forecast, which as we talked to him today, there's a multitude of variables that he will continue to process that will bring us to a different view. But I will say, my guess is that unless there's something significant to take place, I think materially this will be our view. And that is that this year will be down 14% from last year. If you look at the upper right circle there in red, you'll see 6 million housing units were bought and sold in calendar 2019. That's expected to go down to 5.139 million this year. And we're in the middle of that quarter. That is the big quarter down. It's the V, and we're on the bottom of the V right now. That's where we're at for April and May is his projection. So those are going to be the two weakest months, and we're in the finished one of them. Check the box. We got one more month to go, and then we should start seeing that climb take place as we get into the summer, which is scheduled out then for, as I said, 6 straight quarters of improvements. And again, if you were an investor and you weren't in a business the day before and you got into that business and you had 6 straight quarters where the wind was going to get behind you and business was going to get better, you'd bet on that business. So that's the good news. Sometimes you're in the middle of the storm. It's hard to figure out because you're holding on to yesterday. What was in housing isn't. And now it's what is, and that includes Corona. As I say now, it's a BC, before Corona, and then hopefully an AD finally, which would be after it died. But we've got to get past where we currently are to get there. And I think that's just a mindset issue. All of us have to work with a certain mindset that we've gotten through the tough period, or we're close to getting through the tough period, and then it's going to get better from this point forward. And I think these numbers would be beneficial for your customers to see, right? Because there's no reason for a forecaster to come up with, let's just say, more hopeful than our necessary numbers. These are what he's calling for. And in 2021, as the story plays out, we're going to go up 15%. Any business like ours that can grow 15% in a year is a good business to be in. So, I think we're in a better place today. And I'm very, very optimistic that in the time in front of us that we're going to see things get better. Let's talk a little bit then again about housing finance and Supreme Southeast, if I could. Forbearance, I'm going to get to in a second. It continues to create liquidity concerns, but we're getting some solutions, thank God, because forbearance is one of the events, not only, but one of the reasons why we had impacts in our jumbo financing marketplace. And it's one of the reasons that you've heard and experienced credit score requirements going higher for your prospective customers. And again, I want to remind you that under 700 mortgages credit score, mortgages made in calendar 2019, under 700 for the purchase of buying a home, we're talking about 25% of all the homeowners. So if you're under 700, we need those customers. Based on the forecast, we need every customer to get out of this ditch and get back to a really vibrant housing market. So the impact of forbearance as it relates to jumbo financing, as it relates to FICO scores, clearly has been a big event that we've seen, and it's going to play out here in the next 30 to 60 days. Fortunately, as we targeted forbearance as a part of this conversation, we talked about the idea that the idea of forbearance, and just a reminder to everybody exactly what that is. Forbearance is not forgiveness. It is a restructure, if you will, of a government-backed loan. And basically, you don't get your payments forgiven. They either restructure them to pay a little bit more monthly after you've had 3 months of a waiver, 6 months of a waiver where you didn't have to pay, or 12 months of a waiver. Then they either put it on the back end of the loan, or they add a little bit per month, and that's negotiated directly with the servicer. But the idea of not paying and having the freedom not to pay under the CARES Act, which was part of the stimulus plan, on the one side, it's a good idea. On the other side, it created some concerns in both the jumbo market and in the FICO score impacts that we've seen, and those would be detrimental to financing going forward and the housing market going forward if they did not get resolved. Let's move on. So that is what we saw play out. We've had some jumbo shrinking. By the way, I've had questions from really top agents. Is the jumbo market gone? No, it's not. And there are options. Get with one of your Supreme Southeast loans. There's piggyback loans where you can do first, second combinations. There's all kinds of possibilities still out there, albeit fewer than there were just 2 months ago. There still are effective financing solutions in the jumbo market. Don't hear it other than that, because they still do exist. That is, opportunities to get well financed. And I'm not talking about poorly financed. I'm talking about well financed. Good news came in late last week. Finally, Fannie Mae and Freddie Mac quietly, they are preparing to cover servicers' advances on loans in forbearance. That is a substantial move. We've talked about this from the very beginning, that would need to take place to relieve some of the tension in the servicing business, which affects things like jumbo loans and affects FICO scoring from a servicer's perspective. So that was late last week that we had that news release take place. And my expectation is that will ease some of the pressure that maybe has not really impacted the marketplace, but is going to start impacting the marketplace. That didn't happen. We'll still get some impacts because the high rate of unemployment will still create high delinquencies. Forget forbearance. The high delinquencies, or the higher delinquencies, the higher the FICO scores are going to be. With that in mind, I wanted to tell you what we've done, and it's been amazing. The last 2 weeks on Fridays at 1 o'clock, we've run a program called Credit Essentials for Home Buyers. It has been like an amazing oil well blowing up. We've had 150 customers a week ago Friday, 125 this past week. These are customers who are coming voluntarily to our program and getting advice from one of the top credit experts in the mortgage industry in the country, Lisa Myers. And Lisa is explaining to all of them something that all of you need to know. And that is this, is that if you have a 640 credit score, as opposed to a 700 credit score, on a FHA loan, it's going to cost you basically 175 basis points. To put that in real money's terms, that's $3,500 on a $200,000 loan. That just the credit score is going to cost you an additional $3,500. Maybe you won't even get the loan now because of the credit score. So we've got an opportunity with Lisa every Friday. Have your customers go attend. They will get general advice about how to improve their credit score. Mostly everyone can improve 25, 50 points just by listening in on the program and then taking action. And then on top of that, the customers can get directly with a Supreme Southeast loan officer and get individual treatment catered by Lisa, a plan for an individual, because everybody's credit's a little bit different, to get their credit score higher. That's our way as a partner, as a company with a mission serving others before self, to invest in the community right now to make sure every single person who wants to be a homeowner in this country gets a chance to do so. And every single realtor who does business with us gets a chance to get another transaction, which is at this point now, we need everyone we can possibly get. We always did, but they're just that much more important right now to make sure that you all get paid on time, which is what exactly it is that we hope to do every single day in the way that we run our business. So that's a couple of things that's up. And there have been a number of, a big pickup in the Supreme Rescue Service activity. And these are, in fact, opportunities. All you have to do is dial up one of your LOs that are in the accounts. Our rescue service can take a loan that's stuck in someone's pipeline because they've got way too many refinances in their pipeline and their processing's really slow right now, which is almost every big bank is overwhelmed by refinancing, in which case, if they have a purchase that gets stuck in the pipeline, it's not getting moving, we're there to rescue it, close it in 8 days. We can't close in less than 8 days. Otherwise, we would. The government does not allow us to close in less than 8 days. But it's also for transactions that have structural issues where the credit or the self-employment may not even be understood by the underwriter in another company. Give us an opportunity, just like a second opinion at a doctor, for us to take a look at the profile. And in a lot of cases, every single month, we have story after story with the realtor community, with many of you, about us taking a problem from another pipeline someplace else, getting it on course, getting it closed in 8 and 10 days, getting another transaction that all of you can record this year. Because, of course, again, every transaction matters. You know, I wanted to also, just before we leave today, remind you of what's important on our heart. That is to deliver the industry's best customer experience. Our SAT rates are 98.3. That's top box, second box. Our close on time, fund on time, and we define fund on time as we close the loan and we disperse within an hour, so that you get paid on time. Close on time, fund on time, get you paid on time. We're at over 99% year to date, and that's because we make promises at Supreme and we keep them. We keep the promises that we make. And finally, I've already mentioned Supreme Speed, but there's not a company in the universe that can go any faster than 8 days, and we're that company that can go in 8 days. So if you need to get from A to Z because you're competing on a property and you want to commit to getting the seller their money very quickly, in a lot of cases that can benefit a contract in terms of how it gets positioned against other potential contracts. We're going to be there to support you every step of the way. I want to leave you all today with this, is that there's this whole concept about the process of grief, right? It starts out first with fear. And I think all of us, when this thing started, particularly when they started talking about closing the economy down, there was just a lot of fear, and there still is some of that is hanging over. But the next thing that happens is you move from fear to denial. Like, I can't believe this is happening. I know myself, I've woken up a number of days like, is this Corona thing really happening? Are we really shutting down these businesses? And then you move to another level, which is kind of acceptance, where you just kind of accept the fact that this is our new life. This is what's happened. We had a life BC, before Corona, and now we have a new life. And it's different. And then hopefully, if we keep hope, we'll have even a newer life and a better life down the road. That's exactly right. So once you get past acceptance, then you get to frustration. And that's what Doug was talking about. The 9/11 aftermath was, how dare someone else try to take our way of life? And then what I would tell all of you, how dare Corona try to take our way of life? We are going to get out of here. And we're going to be better than we've ever been if you, all of us, if you get the mindset, don't look at what was and wish it was again. Look at what is and accept it, and then do what we do in this country, which is we find a way and we do what's necessary, whatever's necessary to make a business take place. And that's what I'm going to do. And I'm challenging every single person that's a part of the Supreme Lending Organization to do exactly what I just described. I also pray a lot. So if you're a praying type, pray we get out of here, if you will, sooner than later, and then do your job and do it better than you ever have. It's been great having you today. And thanks again to Doug Duncan. We'll look forward to seeing you next Monday at 3 o'clock for another News You Can Use.
Welcome to News You Can Use, presented by Supreme Lending. News You Can Use offers timely information related to the housing and housing finance industry that we believe will benefit you and your customers. This is